So the government created 3 products to help seniors. They created Social Security so that you would have income, Medicare so that we would have medical insurance, and then reverse mortgages so you would have a place to live. So reverse mortgage is actually a government product. I will say I've only recommended it once in my 28-year career. There are pros and cons to it, which we'll go through, but just reverse mortgage in general is when you can do a reverse cash out, you can do a reverse purchase. So let's say you want to buy a house, but you have limited funds potentially, and there's a potential you could run out of money. What you could do is you could do a reverse purchase where you put a down payment down to a home like you would. Now that payment and down payment is dependent on several factors. It depends on how old you are, how old your spouse is. It's all a calculation of how long you're gonna live. No matter what mortgage broker you go to, they use the HECM system, HECM. So it's the same numbers no matter which one you go to, they have to be approved to do it. So just so you know that. But so basically, if you're buying this house for this dollar amount, they would say, okay, based on all of those factors I just talked about, there's a calculation, an actuarial calculation, then you put a down payment on to buy that home. And then you never have a mortgage payment. Now in that down payment, there's also a larger fee because it buys insurance to cover the government. Because what happens, it buys an insurance policy. What happens is that you have a mortgage on that home, the value is accruing against itself. So it is still, the interest rate's typically a little bit higher, which is a con. A larger fee to get in or fees to get in, which is a con. And so that mortgage is adding against itself. And so you have negative equity that's increasing. Now, your value of your home can still go up. So if the increase of the value of your home goes up and keeps up with that interest rate's a little higher now than they were a few years ago, then it's possible that you still have equity at the end of your life or when you sell it. So basically, if you have to move into assisted living or something like that, you can sell the home, take the proceeds. If there is equity and still move and sell the home, you just have to pay off the mortgage. If it's upside down, then you walk away and the government keeps the house. You hand over the keys, then they have insurance policy that covers it. Same thing if you're at the end of your life, your heirs, your executor, if the home has equity, you can sell the home, pay off the mortgage and keep the difference. If it's upside down, you just walk away and it's covered and the insurance cover policy covers it. So the pros of this is that if you have limited funds and you're going to run out of money, it gives you a place to live without having to make a mortgage payment. You can do a cash out of your home and do a reverse mortgage or a reverse purchase. So a cash out would work similarly where you live in a home, it has equity, you take it out, you get the cash out, you could invest that potentially, use that for living expenses and never have a mortgage payment. So that is a pro to that. It just helps you at the end of your life or end in your senior years. If you have limited funds to be in a home, you do have to maintain the taxes as well as the insurance on that. Now, there's a lot of cons to this. There is a chance that the house will be upside down at the end of your life or when you move and you won't have any equity. So if this is a home that you want to leave to family, doesn't make sense. If you're trying to leave assets to family, doesn't make sense, potentially, because it is, and it is a debt that is increasing against you, meaning it's adding and compounding on itself. So the interest is still accruing, you're just not making the payments on it. So it is a negative returning potentially item if the value of the home is not increasing in line with the interest rate. But again, it was put in place to help someone, in their senior years as a government product. It is an option, not one that I've recommended most. It's a negative returning potential there, but it does also give you a place to live. So it is an option for, if you don't have the down payment to do it, then someone who doesn't have assets can't even do this, if that makes sense. You can get the cash out of your house if that's your biggest asset, or not even if it's your biggest asset, you can just get the cash out of the home and invest it and use those for living expenses. So that way, versus if you were to do a cash out refinance, for example, or take a mortgage on your home, then you would have payments. And so getting those funds out and having payments may not help because you could still run out of money, if that makes sense. So it's just an option if funds are limited and your biggest asset is maybe your home, and it gives you a place to live, but it may not be the best financial decision for the whole family. So you need to really, really think about that and vet everything out and look at every other, I would think it's a last case resort type thing, but it is an option and available to you out there.